Hi and welcome to Subject to Finance on Monday the 13th of May. I am a bit behind in doing these, so today there's a bit to catch up on, and I'll try and cover off as much as I can in terms of the last month or so and what's been going on. Lots of things happening out there. As most of you agents will know, the market's up and down. You're having your good weeks and your bad weeks. And that flows through into what we see in the mortgage side of things as well. But on the whole, I'd say that what we are seeing in terms of 2024 is starting to show good signs of improvement over the activity that we were seeing in 2023. So there's some positives in there, and there's some interesting things sort of happening. So I'm going to start off with the thing that most people are interested in when it comes to mortgages, and that's interest rates. And to talk about what we're seeing there. And it's quite topical, as in the last week we've seen ANZ, ASB and Westpac have all dropped their advertised rates by about 10 basis points. And I think in some cases that's sort of right through the range, so that's significant. But in the background, we're also seeing that we're getting rates out of the banks better than the advertised rates, to be honest, and they can be quite substantially different. So banks are in a real competitive space when it comes to origination of loans at the moment. They're still in a position of needing to write new business. They've got a sinking balance sheet when it comes to home loans. And so they've been quite competitive on those non-public rates that they've been offered to advisors, brokers out there in the market. So at the moment, 1 year rate for anyone with a 20% deposit, it's around about 6.85. And on some of the banks, we're seeing that sort of advertised rate at around about 7.25. So significantly different. And we're seeing 18 month rates being negotiated at around about 6.65. So again, it's quite different to what we're seeing in terms of advertised rates in the market. So really important that clients of yours know or understand the value of using a broker in these types of markets in terms of getting some really good negotiated rates. But also understanding what there is available out there on any week. So 18 months particularly popular at the moment, in there at about 6.65, which is a good rate, and probably not a bad bet in terms of waiting out the last of this, the end of this recession that we're in. We are getting indications that there could be movement in terms of Reserve Bank later in the year. It's hard to know. I mean, it's anyone's guess really. But I do think that we're going to see further competitiveness amongst the lenders, and therefore some of those rates might start to come back in even further as the year goes on. With the main banks, there is little difference across them in terms of rates at the moment because of that competitive nature. So the main reason that people are going to want to refinance is more around cash incentives and contributions to that move or restructure. So again, if you've got clients that are looking to do something different, so buying up or just refinancing, really important that they be getting advice on that. And I'd say at the moment with cash incentives being so high, really good to have a broker in the mix there somewhere. Home loan approvals are mixed, still predominantly first home for our business, and I think that reflects what we would expect across the market. A lot of outside of Auckland activity still. Obviously the outside of Auckland market's been far more affordable. Interestingly, we're seeing a lot of activity out of Christchurch. Christchurch is a great spot in terms of entry level or investment at the moment. Really affordable property, good rental returns. Properties all new. Christchurch has the benefit of having been through that earthquake period and actually having really good infrastructure at the moment. And some really nice little things like We would have heard a lot about those red zones after the earthquakes in Christchurch. Most of those have been turned into parkland. So it's really possible to find property that has good access to the outdoors, great for running, jogging, walking dogs. So it's become a really livable city, and we're certainly seeing activity out of it. In terms of cash contributions, for new lending, we're seeing up to 0.9%. And so that's kind of significant. On a $500K, $500,000 loan, that's $4,500 worth of cash. There's an advantage with KiwiBank at the moment in that they are offering the cash and free refinance service. So a good option there with KiwiBank. And banks are generally doing their best to retain customers. So a lot of the time we are holding clients with their existing banks, and the client's getting some form of cash to stay. So banks are doing a really good job on the retention of clients at the moment, which is a good thing, I think. So one area I think that's really interesting is more on the real estate side of things in terms of agent activity and the way properties are being sold. In most cities at the moment, there's a lot of entry-level housing available, Auckland in particular, and at that affordable end of town, those properties are really targeted towards first-home buyers. So it's really interesting that we're still seeing a lot of them going to auction. Why that is interesting for us is if you understand how the lending side of things works for first-home buyers, if it's sub 20% deposit, then the hurdles to getting that loan are higher. Valuation's going to be required, property inspection's going to be required, solicitor sign-off's going to be required, and all those three together add up to $2.5K of cost. So significant risk if you don't go ahead and buy that property, to the buyer that is. So one of the things that we're really curious about is why the real estate industry hasn't moved to more of a fixed price or negotiation approach to that first home or entry level property, the low end of town, which is the new apartments, new townhouse, terrace house type stock, and are still doing auctions in that space. You know, I would have thought at the moment with agents looking to get deals done, not wanting things to drag out, that ideally they would be doing that sort of stuff. And that sort of leads on to something that we are sort of seeing a little bit more of, and that is a little bit more creativity in terms of what agents are doing. And agents that are in a position to doing things such as waiving marketing fees to actually look at getting sales across the line. So I think in terms of what we'd expect to see from the real estate sales side of things is a bit more creativity coming through from agents, and a little bit more thinking about who the product is selling to in terms of whether that's a fixed price, negotiated or auctioned. But yeah, the auction thing is the troublesome, but it's always an issue for first home buyers. It's an age-old issue, but it seems to still be there at the moment. And it makes for a real high-risk proposition for first home buyers who are under that 20% deposit threshold. One thing we're seeing from the banks is a much bigger appetite for those first home buyers under 20%. And ANZ is particularly good with these, and you know, we're seeing really good fast turnaround in terms of getting those approvals through for those types of loans, 3 to 4 days, which is great. Overall, lending criteria hasn't changed much. The banks are all really open for business, and actually they are stretching further than normal in terms of making things work, particularly for first home buyers. So really positive approach from the banks at the moment. And so that side of things is really looking favourable. And we're starting to see a bit more activity in the investor space. We're starting to see a little bit more activity in terms of offshore buyers. So some really good little green shoots coming through in terms of what's happening out there in the market. One of the things I had an opportunity to talk to a journalist about this week was why some of the people that are looking to trade up in terms of new houses aren't in a position to get finance. And I think a lot of that is more around a number of things. One is there's been a lot of consumer credit put in place over the last few years. We all know that in COVID people went out and bought boats and new kitchens and other bits and pieces, and they either did that as consumer debt or they did it against the value of their home. So I would say that indebtedness had got up there a little bit in terms of that period of time when people were spending a lot more time at home and spending a little bit more time on their home lifestyle. And what we've seen recently is valuations coming back on those properties, so debt to value is a little bit higher than normal, and that's putting some restrictions in place on those people that are looking to trade up and what they can do. But I also think there's always that little bit of an issue where people, when they're selling their own house, worry more about the value they're going to get than the fact that they're buying in a market where they're actually going to buy the next house in that same market at a lower price. They tend to get a bit more hung up on the price that they're selling for and not the fact that they're actually paying less for the property that they're going into. So a bit of a mindset change, and that goes to the economy and people just feeling a little bit more negative. So we've got to get through that kind of mental barrier and open up the market a little bit in terms of people being a bit more comfortable with doing things as we get out the other side of this recession. So that's the main stuff I can think of this week in terms of covering things that have happened in the last month or so. I hope that's useful. This week I've got another interview I'm going to put out with James Law, who's a owner of a real estate company in Auckland, so you'll be able to listen to that and get his view on things, and we'll talk more soon. See you next week.